Okay, everyone, this is Jose Blasco here. We're about to start. This is a sound check. Please go ahead and use the chat box to just give a quick confirmation that you hear my voice. That would be appreciated so I know we can start. Just 20 seconds to go, guys. Okay, so we are reaching the top of the hour. Wonderful, guys. I can see that you guys are connected and you hear me and you see my screen, so it's all good for us to begin. Very nice, very nice. So let's begin, everyone. Hello, everybody. Today it's August 25, 2019. My name is Jose Blasco. I will be your guide today. Today we are getting together for sharpening purposes. So it's all about taking our knowledge, taking our skill, and keep taking it to the next level. That's why we call it sharpening. And that's the purpose of today's session. Okay, so today we'll be talking about, let's call it the theoretical part of trading, if you wish, the processes, the tools that we use, how do we approach trading. Okay, so we are ready for the weekdays when we do the live sessions, so we can apply all these techniques, theory, concepts, tools, etc. We can go ahead and apply it during real-time market conditions. Okay, so taking advantage of the weekend here. Anyway, before we start, disclaimer: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this will take us to the ending part of the introduction. Therefore, the session is formally introduced and we are now beginning our sharpening session. Okay, here we go. Very good. So now what's the plan for today? Okay, well, the plan for today, it's been a while that we haven't conducted Q&A sessions, and you know, a few of you have sent emails to us suggesting that we conduct some Q&A time. And therefore, I would just like to use today's session for that purpose. Just openly go ahead and be ready to answer any questions you may have, no matter the subject, no matter the trading style, no matter the asset, if it's forex or futures or options or stocks or whatever it is that you trade, and go over, you know, processes, tools, and everything, and answer your questions. That will be the plan for today. Okay, next weekend we will begin getting ready and preparing for September, because during the month of September we will add more assets for the sharpening short term. Up to this point, we spent a few months focusing on the S&P and the Nasdaq, which are amazing. But there are other amazing markets as well, such as crude oil, gold, treasuries, and we will be putting some time into those markets as well, starting in September. Okay, so today, again, we are not going to get into those markets yet. Today, we are discussing questions and answer, and therefore, I am all yours when it comes to addressing any concerns, any questions you may have, or if you want to also talk about trades that happen to you, specific situations you found yourself into, even though you may understand the process, but you found yourself in certain situation and you want to consult or you want to discuss it, I'll be more than happy to make time for that as well. Okay, so again, I am all yours, my friends, and I would expect from you now to use the chat box to type your questions, simple and basic or advanced and complex, it doesn't matter. Doesn't matter the style, doesn't matter the asset, doesn't matter the time frames. So that's the plan for today. Please go ahead and type your questions, whatever they are. So we will be addressing those questions today. Okay, I can see a few more members are joining the session as we speak. How are you, everyone? Good to see you all. And I just said, if you are just coming in, I just said that today's session is a Q&A session. Therefore, I am all yours when it comes to questions and answers, okay? So go ahead and use the chat box for that. How are you, Eric? Good to see you. Very good. Hey, how are you all, everybody? Very nice to see you all. I can see your hellos in the chat box. I don't know if you heard me a minute ago. I was just saying that today is a Q&A session. So I am happy to look into your questions, whatever they are, and no matter the asset, the style, the time frames, etc., etc. And I'll be more than happy to take those questions. Okay. And by the way, if your questions are not related to the methodology that I use when we do the sessions, I'm okay too. Okay. If your questions are generic about the market, or actually you want to discuss other methodologies, and I'm more than happy to take care of any questions you may have, no matter the nature of your questions. Okay. Very good. Here we have a question from Lisa. How are you, Lisa? Nice to see you. So Lisa says, Jose, when a UFO forms in your favor before you reach 1-to-1, do you move your stop? Yes. So let's go ahead and take a look at our flowchart. So here's our flowchart, okay? And if you look at the trade management section here on the right portion of the chart, notice that we have the UFO trailing exit right here, which is an optional technique. Just like the too far, too fast is also an optional technique. Just like having a time stop is also an optional technique. So the idea is that, number one, you decide if you want to apply all those trade management techniques, or maybe you skip some of the optional, okay? So assuming that you decided in your plan that you are indeed interested in trailing your stop as new UFOs form during the life of the trade, then all those techniques that we have in the trade management box would apply at the same time. In other words, it's whatever happens first, would imply some action on your side. So let's say you got into a trade and you reach your safety target, okay? So then you exit half of the position. Let's say that before you hit your safety target, the time stop triggers, then you act on the time stop. Let's say before you hit the safety target or the time stop, the final stop hit, but then you're out of the trade. Let's say while you're waiting to hit the safety target, let's say the safety target is a little far and the price starts moving too far, too fast, then this would be the technique that you use and you would move your stop. Let's say before you reach your safety target, you have a new UFO that just formed, then you trail your stop. So in other words, actually I just said it already, anything that happened in this box, which is the trade management box, anything that happens triggers an action on your side. It doesn't matter what happens first or what is the sequence on how things happen. If you choose to use those optional techniques, which we have 3 optional techniques, isn't it, for trade management, if you choose to use them all, for example, then anything that happens trigger an action on your side. Okay, so the answer to your question, Lisa, is yes, you do move your stop even if you didn't reach 1-to-1, which is your safety target. Here we go. Subhash, question from Subhash. How are you, Subhash? Nice to see you here as well. I have just an observation that when the trend in the common time frame is sideways, is it likely stop out? It likely stop out is more in the last month Forex trades observation. It reacts from 20 EMA. Could you please share your views? Let me reread your question here because I'm not fully sure I totally get you. I have just an observation that when the trend in the common time frame is sideways, it's likely to stop out more. So I believe I get your question. So basically what you're saying is that when a market is sideways, okay, when a market is sideways, you are more likely going to be stopped out instead of reaching your targets. That's what that's your observation. And it seems that you have been observing not only the 9 EMA, but the 20 EMA as well. And it seems that you have seen some reaction from that EMA as well. Okay, so please correct me if I'm wrong on the interpretation of the question, okay? So The answer to your observation is that you have a good observation, okay? And that's why, let me bring TradingView here, okay? So here's TradingView. So you have seen me many times when we do the get-together sessions that I often go through the list of currencies, isn't it? And when I have a situation like the one we have with the Australian New Zealand dollar, where we have a clear confirmation of the market climate, where we have a clear close below the average and the DMI confirms that point, and the climate is confirmed, then you have seen me happily plan the trades. Where there have been times, okay, let me see if we find an example. That one is confirmed as well. Aussie Swiss franc is also confirmed. That one is also confirmed. CAD Swiss franc, that is confirmed. That is confirmed. That is confirmed. This is confirmed as well. This one also confirmed. Okay, let me find a right example. I'm sure we'll find one. This is all confirmed. All confirmed. All confirmed. Here we go. This one is not confirmed. Okay, so you can see that you have a close below the average. Okay, but the DMI is still pointing blue. So there is just a little bit of blue, but there is blue. If you pay close attention to the top, it's blue. Okay, in other words, we have a contradiction. Even though the market movement is going below the average, okay, we do have the DMI still pointing up instead of pointing down. So we have a contradiction. And this would be the case of a non-confirmed climate, okay, a non-confirmed climate. If you look at a non-confirmed climate, very often, if you observe this non-confirmed climate in different time frames, you would probably call that a sideways market. Okay, this is very often the case when a market goes very sideways. You know, you don't have a clear, you know, confirmation of the price direction, and therefore that's when you start getting conflicting information between the DMI and the EMA. So that's why when I'm dealing with Forex, you will see me that if I don't have a clear climate, I just switch and go for the next currency. Why? Because we have many currencies, and I know, as you said very well, Subhash, I know that when a market is not clearly defined when it comes to its direction, when it comes to its climate, then you have less odds. You are using the term sideways, which is a term I rarely use, even though I totally get your point. Normally I talk about confirm or not confirm climate, okay, but it's kind of the same. And you know, again, you are absolutely right. When the climate is not fully confirmed, then we have the situation where we have less odds in our favor. So when dealing with Forex, given the fact that we have many currency pairs to choose from, there is no need for us or for you to go ahead and force trades on a currency that is, as you said, moving sideways or doesn't have a clear directional movement well defined for us. So then just skip it and go for another opportunity because it would be higher probability. Now, in other cases, you have seen me, like when dealing with the Nasdaq and the S&P, okay, you have seen me execute the trade even when the climate has not been fully confirmed. Okay, you've seen me not too often, but sometimes you have seen me execute trades in non-confirmed climates. Okay, is that crazy? No, it's not crazy. Is it less probability? Yes. So why did I do it? Well, because we are only dealing with the S&P and the Nasdaq. It's only two markets. Okay, and therefore, you know, if I was to say no to one of those, basically, you know, then I don't have a trade for maybe, you know, 30 or 45 minutes later, right? So then I've been taking those trades. Next month is September, as I said a minute ago. I will be utilizing more markets apart from the S&P and the Nasdaq. We'll be using crude oil, gold, many other markets. And when we do that, you will see me be pickier than I used to be. Because now, since we'll have multiple futures markets to choose from, then I will only be trading confirmed climates because they do carry higher probability of success. Even though, of course, a non-confirmed climate is still a climate and you can still catch a move, but it is more likely that that move happens when the climate is confirmed. Okay, and in the end, it's all about probabilities. Okay, so that would be the case. Okay, so this is the first part of the answer to your question, Subhash. It's a very good question. The second part of the answer to your question is that you are commenting as well on, apart from looking at the 9 EMA, which I'm using here, Okay, you are commenting that you have been observing the 20 EMA. Okay, and there have been times where you have seen that 20 EMA. I mean, you can see here very clearly that 20 EMA creating those beautiful, nice bounces, right? And why is that? Well, because computers use them. Okay, if we go back to months ago when we did our 4 sessions in the sharpening, right, which we called sharpening intraday 1, sharpening intraday 2, 3, and 4, we talked about what's important about that moving average is that it represents potential on-field orders to be added in the market. Okay, so and you can see that many times those moving averages, and by the way, no matter the figure, okay, if you pick, I don't know, let's use another Fibonacci number 89, for example. Okay, so there will be times where, look at that, you know, it's bouncing from the 89. If you pick, I just click on the wrong place. So if you were to pick another fib number, like for example 55, okay, so you're looking at the 55 average. Well, look at that. You know, in here it seems that maybe, you know, maybe they're responsible for some of this reaction. So again, all those moving averages are being traded by computers. Okay, and you can overlay as many averages you want on your charts, and you could apply the same methodology that we do using the 9 EMA. You can apply it with any other EMA and it would not be wrong. Okay, it would not be wrong. So if it's not wrong, why is it that I use the 9? Well, because remember also what we do with the common time frame. You probably remember this from the sharpening lesson that we did on intraday 1. Let me let me repeat it because it's a very important concept. You may remember I got very serious at some point when I said the only way to make money is to have more people to buy after you bought or to sell after you sold. We need more people buy after we bought. We need more people sell after you sold. So that's why we use that's one of the reasons why we use the common time frame when doing climate analysis, meaning that the climate not only defines what is the current direction of the market, but it also represents what is the direction in which most of the people trade. And remember, if you buy, you want more people to buy after you buy. That's why the climate is so important. I mean, that's one of the reasons. Okay, so now when you apply an EMA to the common time frame and knowing that those EMAs are traded by computers and they represent potential addition of on-field orders in the market, on-field orders that are not in the market yet, okay, then you have many choices. You can use the 9, you can use the 21, you can use the 13, you can use the 34, you can use many EMS, which are the ones that are being used by those computers that belong to the large market players, as we covered before. But why is it that I use the 9? Well, because the 9 comes by default in almost every single platform in the world. When you install an EMA, by default is the 9 in many platforms. And again, this is aligned with the concept of common time frame. Again, we want to spot as many people are there because for us to profit, we need more people to buy after we bought. So the 9 is likely to be used very often because it's the one that comes by default in all platforms when someone inserts an average. Okay, but also the other reason why this one it's probably more efficient than the 20, it's because indicators, all indicators including averages, they have a downside. And the downside that they have is that they lag. And it's okay because even though they lag, there's still a reason for potential addition of on-field orders in the market. So it's fine. If you were to use it by itself, then it's not fine. But because we combine it with the UFOs, then we're fine, okay? But still, I would like the lagging to be the least as possible. Because a 20 EMA or a 50 EMA or a 200 EMA will give you a calculation, will give you a buying or a selling price, which is coming from a calculation that represents 200 candles in the past or 50 candles in the past. And the more candles that in the past you use, the higher the probability that whoever is using it may have lost the interest. Where if the person using that average is using a very short average, okay, I mean, those price, you know, I mean, how many times if I use, let's go extreme here for a minute. If I use the 200 EMA and I maximize this chart, okay, let me load more candles. Okay, interesting. I just lost my chart. Yeah. Sorry for that. So, I mean, how many times in that chart do we hit the 200 average? Okay, well, since May, okay, just to pick an example, in this 4-hour time frame, since May, we have had one time where that average has been touched. Now, did it create some sort of a reaction? Of course. Why? Because computers trade it. Okay, if you look in the past, did it create a reaction here? Yes. Did it create a reaction here? Yes. Did it create a reaction here? Yes. So again, those averages, as I said, they represent potential additions of unfilled orders that were not in the market, and that they are added because of the average. And they are added because the average is not a static figure that remains static. It's changing through time. That's why those computers keep adding orders or removing orders because of those averages. So again, it's a pretty intelligent concept to utilize in our trading combined with the UFOs. But what's the problem of using a 200 or a 20? Well, you got less opportunities compared to using the 9. And on top of that, the 9 is more common than the 200 because it's the figure that comes by default in the majority of trading platforms. And on top of that, okay, because it's more current, you have less lagging, which reduces as well the probability that orders will be canceled, okay, and therefore create scenarios where you have more likely bounces and more opportunities altogether. Okay, so all of this is why we use the 9. Okay, so of course, using any other moving average would be just as fine, based on the concept that we covered again in those sharpening sessions for intraday. We got 4 that are recorded, isn't it? Intraday 1, 2, 3, 4. And I'm just re-summarizing it and reminding you, okay? And certainly the 9 will work very well when the markets are pushing in a specific direction. And when the markets are more sideways, coming back to Subhash question, then it's likely that the 20 or the 50 may work better. Why? Because in a sideways market, normally the market will move, will create bigger swings of price, and just go from that swing low to that swing high, and that's a sideways market. And those swing highs and swing lows will normally be seen or line up with moving averages that are of a longer period, where shorter moving averages, like the 9, will not represent swing high and swing lows. They will just represent a continuous price action, because those moving averages are closer to price all the time because they only used 9 candles to calculate the average instead of 20 or 50 or 200. Okay, and again, for a directional trader, it's likely to be more efficient in the sense that you will have more trades, you will have less lagging, potentially you will have more common people join you in the trade because it's a common number in a common time frame. So again, it's just putting all those forces all together to increase your odds. Okay, that's what it is. Okay, and again, coming back to the sideways. Okay, so if you were to realize that the market that you trade is sideways, or coming back to the terms that I normally use, if the climate was not confirmed, then go for another currency. Okay, go for another currency and don't force a trade. Okay, because that way you have more odds. Anyway, long answer to a very important question, Subhash. So thank you very much for the question. Hopefully I did answer the question. Let me see. I can see a few more comments from you. So 9 EMA work absolutely fantastic. I was observing only on unconfirmed climate, especially after stop out. It is clear. Thank you for the clarification. Yes, absolutely. My pleasure. Very good question, Subhash. And again, I love what you said. That when you talk about observation, the way I take your comment about observation means that you are putting time and effort into making the methodology second nature in you, and this is the way to go to build the skill and the confidence and become that efficient trader that we all have as a goal, isn't it? So good job there, my friend. Back to Lisa. I am not clear on how to use CCI to reallocate portfolio deltas. Can you please review? Yes. So let's see. So here is a TradeStation. Okay. Commodity channel index is right here. Okay, so here is commodity channel index. Okay, so basically what we said is that when we did the portfolio session, what we said is that even though a climate which is defined in a specific direction, dictates the portfolio exposure you want to have. The fact is that sometimes a market will move too far, and not only too far and too fast as well in that direction, and therefore that climate begins to be unsustainable. Okay, and when that's the case, even though you have a climate and it's defined, well, relying too much on that climate starts making no sense. Okay, and that's why we're using CCI. Okay, we're using CCI precisely to define when a climate is likely to begin not being sustainable. Okay, for example, at this moment in time, okay, so we've been, you can see we got red dots here below. So we've been in a down climate, okay, but then the S&P, well, actually this is not the S&P. Let me move to the S&P. That was Tesla, because we apply the CCI to the S&P, isn't it? So let me change that to the S&P. Okay, but you can see here that, we got the red dots, but apart from having the red dots, what happens? We have a clear indication from the CCI that, this market is way too overextended to the downside. So at the moment in time, it is clear that you are in a down climate, but it is also clear that this down climate, it's now becoming close to unsustainable, and therefore you need to work on your deltas to be properly hedged. Because if you keep adding short positions in a climate that may not be sustainable anymore, then you may get in trouble. Okay, so let me see if I can find the notes. I think the best way to answer your question, Lisa, would be to bring the notes up. Okay, so just give me a second for that. Give me a second. I do remember. Yeah. Okay, so here's what we have. Okay, here are the notes that we had. So here we go. So we had notes here when it comes to building and maintaining a portfolio. Okay, those were our notes. So let me see. Okay, so here's where it begins, right? And I'm just gonna go over this as a little bit of a reminder for everybody, okay? So it says here that we need to use a guide that dictates how much and what type of exposure we need. The exposure in portfolio management is measured by using the Greeks, okay? Even if you were not to use derivatives such as options, you would still use the Greeks, in this case delta, to measure your exposure, okay? So example, for a portfolio made of equities, it is classical to use the S&P as a guide, okay? The guide that will dictate how much exposure we want, okay? So that's why in my chart, okay, I have loaded the S&P. As you can see right here, I got the S&P symbol on my chart, okay? So I'm looking at the S&P in the daily time frame. That's what I'm doing. So now, using the common time frame, which in this case is the daily time frame, you will assess the climate that will define the delta percentages you need. We said in a confirmed climate, okay, okay, you will want 66% of your delta to be in the same direction of that climate. So in other words, out of all the deltas you have in your portfolio, 66% of your deltas should be to the long side if the climate is an up climate. 66% of your delta should be negative deltas if it's a down climate, and therefore you have ruby colored dots in the bottom part, okay? So that's the first thing, when the climate is confirmed. Second case is when the climate is not confirmed. Okay, well, when you deal with a portfolio, if the climate changes from confirmed to unconfirmed, like what's happening right now, where we had a confirmed climate going down, and then it switched to unconfirmed. Okay, unconfirmed. So we have 4 days in a row of unconfirmed climate, which is quite rare, isn't it? But that's what we have. So what you could not do is, just because the climate went from confirmed to unconfirmed, is just close the whole portfolio and just wait until a new climate defines and start again building the portfolio, because to build a portfolio, it takes time. Some of your trades are traveling towards a target. You need to give it time to get to the target. Some of your trades are collecting time decay. You need to give it time for time to pass and the options to lose value. So you cannot just close everything, right? But at the same time, you have less probability in your portfolio if the climate changes from strong to weak. So what do you want to do? Well, you would then want to move to a 50-50 delta distribution in your portfolio. And this is done very simply by looking for longs if you had too many shorts, or looking for shorts if you had too many longs. So you would maybe enter a new or two new positions to balance out the deltas. And, again, you would end up with a neutral delta position while you have some positive gamma. And this would allow you to start making money again as the market starts moving again and redefines its climate. Okay, so I believe that this is very clear because this is quite common sense, if you wish. Lisa's question has to do with a risky climate. Okay, so what's a risky climate? A risky climate is when the market goes too far too fast. And how do you know that? Well, we are using CCI to measure this. Okay, we have applied CCI, the Commodity Channel Index. Okay, and when it crosses the bottom line or crosses the above line, and very nicely here in TradeStation it changes color, that's an indication that tells you the market has stretched too much. And when the market has stretched too much, as I said a few minutes ago, it means that it may not be sustainable. So the way you will want to treat it is, if you got the indication 2 days in a row, okay, 2 days in a row, meaning that, for example, here, okay, you had the indication 1 day, okay? That day, you were told the market is moving too far too fast, okay, on that indication, right? But the thing is that the next one, okay, it was back up, okay, it was back to be gray. So it was only 1 day. So this would not classify or qualify as risky climate, okay? That would not classify as risky climate, but this one would classify as risky climate. That one would classify as risky climate because price spent a few days with the same indication, with the same light on, okay? So that would be the case, okay? So when that happens, what you should do is just treat your portfolio like the climate is unconfirmed. So you want to go back to your 50-50 distribution. It's the very, very same thing. Just go back to 50-50. That's it. Because when a climate is unconfirmed, anything may happen. And when a climate is risky, anything may happen as well. So what do? Go back to 50-50 just to be on the safe side. Okay, so that's my answer to your question, Lisa. I see a few more comments, so let me read to see if I answered what you needed. So Lisa said, so 9 is more reactive than 20 and higher probability. Yes, it gives you more opportunities, right? It's more common. Okay, it's a common on top of common, right? So the answer is yes. Lisa, Jose, I have started monitoring 15-minute UFO at 9 EMA to see if I adjust my stop to the 15-minute UFO versus the edge timeframe UFO. Would I avoid stop outs, assuming I am okay with the risk? Have you considered this? Well, yes, I have, but again, I'm going back to sharpening intraday 1, 2, 3, 4. Okay, and now we need to talk about what is the purpose for edge timeframes. Okay, why do we call edge timeframes edge, right? And the reason why we call them edge is because somehow we enter the market in a way that is more invisible. So you get a higher probability of being filled at the right price because you are not using the same time frame everybody uses. And for you to buy, someone has to sell, and vice versa. And the second reason is because now you're using the same time frames that the large computers utilized by the large market players are utilizing. So the UFOs not only represent on-field orders, they actually represent on-field orders that potentially belong to the large market players that use the large computers that control the market. Okay, so could you use the 15-minute time frame? Absolutely. Are there some institutions and large market players out there in the world using the 15-minute time frame? Yes, absolutely. Okay, would it be more precise and more efficient Using an edge time frame? Yes, because the 15 is a common time frame, not an edge time frame. Okay? So, again, my recommendation is not to divert, even though I understand. And if you don't mind me to make one more comment, Lisa, which is not necessarily for you, even though the question is coming for you, but this is a comment for everybody listening right now. And it may be you too, Lisa, but I'm not sure. Okay, so this is for everybody. When I read or when I'm being asked a question about avoiding stop outs, immediately something triggers in the back of my mind. And I may be right, I may be wrong, it may be your case, it may not be your case, but it was my case when I started learning how to trade many years ago, that I was really uncomfortable with losses. Okay, I am a perfectionist. I am coming from, before I was a trader, I was working in the telecom industry as an engineer. So I was used to the sure thing. Okay, and trading is all about probabilities, it's not about the sure thing. And therefore, I was very, very uncomfortable in my very early stages when it comes to taking a loss. It would bother me so much. You could not imagine how much it would bother me. It would even make me feel I'm not doing the right job, And the fact is that losses are part of trading. So this concept of avoiding losses, I understand in a perfect world we would avoid the losses, but in that perfect world, another way to say perfect world is also say utopia, right? And utopia is something not realistic, right? So, the methodology you use will produce profits and losses. You have to be in peace. You have to be in sync. You have to be okay with those losses when they happen. And what is key, and the mindset that we all need to develop to succeed in this business, is that when you take a loss, it's fine. Don't try to avoid it. What you need to do is to make sure that when you take a loss, is the smallest figure as possible. That's what you need to do. Make it as small as possible. And therefore, in an edge time frame, let's say a 2-minute time frame, for example, then the difference between the entry and the stop is likely going to be much less compared to the distance between the entry and the stop in a 15-minute time frame. So true is that it's possible that you avoid a few losses by using a larger time frame, not because the UFOs are more powerful, but because you have more distance to the stop, and therefore, statistically speaking, it's going to take longer, and maybe it doesn't even happen to reach your stop. Okay, but and by the way, you can confirm that by looking at UFO stats in a lower time frame and a higher time frame, and normally you would see that lower time frames have higher performance stats than higher time frames, which is counterintuitive because the majority of market analysts in the world, they would tell you that the higher time frames are more relevant than the lower time frames. Okay, well, that's true for many things, such as the climate, but it's not necessarily true when it comes to order flow. Is that making sense? So it's important not to get confused there. Because, especially if you have traded for a while, you may have certain, embedded beliefs, right? And it's important that our beliefs are aligned with the reality, okay? And that's something that you can measure with the AutoUFOs, okay? So it's not that I say it, it's that you can see it yourself, okay? And so again, coming back to what I'm saying is that if you were to execute those trades using the edge time frame as a small time frame, and let's say you were to be stopped out more often, but the size of the losses was to be less, at the end, you would actually make more money than the other trader that got stopped out less often, but also traded less often, and also lost more when he or she got stopped out. Okay, so again, it's all about balance, my friends. Okay, there is no magic formula. It's the balance. It's like, when you go to this restaurant and you try this amazing recipe and it's so fine and tastes so good, you can get the same recipe in another restaurant. So why is it that in some restaurants it tastes better than others? It's the mix that was done in the kitchen. Is that making sense? That chef is creating a better balance when mixing the ingredients than the other chef. Okay. And by the way, that was a very simplistic way to talk about cooking, but you got my point. Hopefully that makes sense. Okay. So again, Lisa, I'm not saying that this is your case. Okay. And I know that you are an experienced trader and probably what I just said, you have overcome this since a long time ago. But just in case, I wanted to throw it out there because sometimes it's healthy to talk about basic stuff. Okay. It helps everybody, including me, just to say it. It helps me too, because I am human too. And we all make mistakes at times. but also for many other listeners that can be listening to this live or record it at a different time. It's a very important message for you to think about it, and maybe you want to just spend a little bit of time and just think about what I said, or listen to it 2 or 3 times, and think about if you are doing that in your trading, right? And if you are not doing it, what can you do to make your trading resemble what I just said, okay? And this would help your results. Anyway, I can see more text as well here, and I'm missing some questions from Orlando and Subhash, but let me complete my answers for Lisa, okay? And then I'll go for the other questions. So Jose, I have started monitoring. Okay, that was the tricky part is factoring in portfolio risk with adjusting deltas. Yes, you are correct. And again, Lisa, the way I conduct the long-term sessions that we do on the Thursdays, normally the longer-term sessions, normally I will be using at the common time frame as daily, and then I will be looking at the edge time frame as the 55, as I have on my screen right now, isn't it? That makes you a pretty active portfolio manager. And sometimes you have to run, and if you don't run, you may miss a trade. And if you miss a trade, you are messing up your portfolio deltas. Okay, so if that is a little too intense or too quick, or you happen to be a person who has less time to be in front of the screen to manage your portfolio and so on, then the way to fix it is actually quite simple. Just switch to the weekly time frame for common. Okay, your common time frame would now be weekly, and then instead of using the 155, okay, you will just go ahead and use the 144, okay, and you go for the next edge time frame, and that's it, okay, and you just switch everything one up, and now you have more time to do everything you do, okay, and hopefully this alleviate a little bit of the problem, because what you said is absolutely right, but normally it comes with, kind of lack of time or not being available at the time when you needed to and things like that, okay, so just switch your time frames to something more relaxed, and that's it. Good, perfect. So last question from Lisa here. Okay, I get your point. Edge is key. I was seeing a few cases of stop out by a couple of ticks that align with the 15-minute UFO. That got me overthinking it. Thanks for your word of wisdom. My pleasure. And again, what you said makes sense too, because a UFO is a UFO no matter the time frame. But again, there are pockets of orders all over the place in the market. The key is to rely on the ones that are more reliable, okay, and that's why edge timeframes will normally help you better than common timeframes for that purpose. Where for climate purposes is the opposite. For climate purposes, the common timeframes will normally do a better job compared to the edge timeframes. Okay, cool, very good. So let me rewind a little bit, and I can see here Orlando. How are you, Orlando? Good to see you here, my friend. I know you've been very busy recently, and I've been missing you. Okay, so I'm glad to see you here. Jose, sorry for asking this simple question that may have been answered in previous sessions. How does the indicator climate works? What does it take into account and why? The auto climate, Orlando, is 100% the same process that we have been running manually when looking at an EMA and the DMI. Is exactly the same thing. Okay, but instead of looking at 2 indicators, it just shows you the result, because AutoClimate is processing all that information in the background, giving you just one dot that tells you what to do. Okay, so again, it simplifies your life and your process, but the process, okay, is nothing new, is nothing different, is exactly the same thing that we used to do. Okay, exactly the same thing. Okay, so no difference there. The only thing, if you wish, is that AutoClimate adds a little bit more advantages. Okay, and in this case, it's 2 things. Number 1, you have this vertical line, okay, which represents the distance from the current price to the average in ATR multiples. So, for example, from here to the average, okay, you have all these vertical distance. Now, this vertical distance is in dollars, okay? It's in dollars. Well, if you were to take the ATR, which that day was $3.52 per day, okay, and you were to measure this vertical distance and you were to divide that distance by the ATR, then you would get that figure. Okay, that vertical high represents the distance from the current price to the average in ATR multiples, which that day was 3.11. That was the reading that day. In other words, you are very far from the average. In other words, you are very far from your UFO. Why? Because we pick UFOs lining up with the average. And because you are far from the average, it also means you are far from the UFO. So in other words, if that day you plan a trade, I'm not going to say it's wrong, but you are likely going to waste your time. Okay? You are likely going to waste your time because the price is far away. Okay? Where if you were to plan a trade on that day, for example, okay? So that day, the measurement was 0.76, which that means that, in a normal case, in less than 1 day, you should reach the average. So what does that mean? Well, that means that, you probably it's time for you to plan the trade because you are likely to get filled in that common candle time frame. Okay? Now, on top of that, okay, when you double click on AutoClimate, you can now you notice that you have an alert parameter. Okay, so I have it as 0.5 by default. So if you click alert and you enable the alert, now every time a market, and you can do this in the radar screen too, okay, every time a market is closer than half of an ATR, closer to the average by less than half of the ATR, or whatever value that you input, you will be alerted. So now you are being alerted that not only you have a defined climate, but on top of that, you are close to the average price and therefore potentially close to a UFO. So it's worth it to look at that chart and plan a trade because you are not likely going to waste your time. Okay, you are likely going to get a fill because price is close to the average. Okay, so that is one additional bonus that comes with AutoClimate that doesn't come with DMI and EMA. Okay, so the process is the same. The dots, the sapphire color dots and the ruby color dots, it's the same process as the EMI and the DMI, EMA and DMI, but the vertical line, it's just a practical calculation so we can get alerted when a market is close and we don't waste our time when a market is far. Okay? And finally, the other addition, the other bonus, okay, is those three figures on the right, where the current figure here on the right, which is number 4, tells you how many candles have already been in the current climate. As you can see, is 4. But what's most important is the value on the left, which tells you in an up market, what is the typical amount of candles that this market will remain in an up climate, which is 8. Oh, sorry for that, which is 8. Okay, so when the market is up, this market tends to remain up for 8 candles. And currently we've been up for 4. So in other words, it's telling you a statistical way to think about how much longer your climate may last. Okay, so this climate is likely to last. Why? Because when that market goes up, statistically, it tends to last for 8 candles. Let's call it 9, 8 point something. Let's call it 9. Okay, so you know that if you were to plan on a trade, okay, you are not doing something crazy. You are doing something that probably makes sense. Now, of course, as you can see, we just got a close below the average. So when the market will reopen on Monday, we're going to have a red dot here instead of blue. Okay, so the climate has changed because this is statistics. The fact that most of the times when the market goes up, it lasts 8 candles doesn't mean it's going to be like that forever. So in this case, after 4, the market switches to red. Okay, so there is a change of climate. And the next value tells you precisely what tends to happen when the market is a down market, is a climate going down. So as an average, okay, statistically speaking, in this particular market, every time the market goes down, the amount of candles, okay, that it will last in that particular climate is 4. Okay, statistically. Now notice that in recent times, statistics are being broken big time. Okay, big time, much more long-lasting down markets than up markets. So as time passes, those statistics will start switching, and if the market keeps falling and falling and falling, If the broad markets, long term, they were to become a downtrend, you would see that the down climates are actually more powerful than the up climate, which in this case, we still have statistics suggesting that when the market goes up, it's going to be stronger. Again, the future will prove that to be true or not, but it's statistics. So the auto climate, again, to summarize it, not only does exactly the same process that we have been using for a while, but is giving you two bonus pieces of information that make your life easier and your trades higher probability. Number one, we have a way to measure now how likely a climate is likely to last. Okay, earlier we only knew if it was up or down, confirm or not confirm. That's it. Now we have a way to know how likely is it going to last for longer. Are we late to the party or not? Okay, and then the second one with the vertical line, we have a way to measure how far away from that ideal price, which is the average, okay? And if we have a UFO there and we are close, time to plan a trade. If we are far, you are wasting your time. Just look at another market and go back, next day or next 15 minutes if you're doing intraday and replan a trade later on, because right now it's a waste of time, okay? So that would be my answers to you, Orlando. Let me see your comments. I have missed you too. You're very kind, Orlando. Orlando, what is new in version 2? Yeah, version 2 is just an automatic way to have auto climate inserted in radar screen. So if you were to insert auto climate, where is it? Radar screen. So if you were to insert auto climate in radar screen, okay. So let me go ahead and insert. I'm just going to insert Dow Jones Industrial Average Stocks, for example, just to have a few symbols. Okay, so I have a bunch of symbols here. That's the Dow Jones, right? So if I was to insert auto climate, so yeah, auto climate is here. Here we go. So if I was to insert, and also I would like to change the time frame to daily. Okay. So here's auto climate version 2, and when this loads, okay, here we go, automatically you get the right coloring. Okay. In version 1, to get the right coloring, you had to come to studies, edit, and you had to change an input manually, which that input now disappeared, because auto climate now can recognize automatically if it's a chart or if it's a radar screen or if it's a scanner. You don't need to change anything manually. Okay, so the process, the calculation, everything is 100% the same. The only thing that changed is for convenience purposes, you don't have to change inputs for radar screen. Last question from Orlando here. How do you calculate how long a trend candles will last? It's just pure stats, okay? So what AutoClimate is doing is, depending on how many candles you have loaded on your chart, let's say 500, let's say 1000, so it's looking back in time to all the cases where it was an up market, when it was a down market, and it's just collecting all of this in a specific type of data. All of this is like a series of data. It's all stored, and once all that series of data is stored, then a standard deviation calculation is applied to that series of data, and you end up with a number that represents what is normal. Okay, and normal in probabilities means likely to happen, and that's what those numbers mean. So 8.62 candles going up, it's normal, so it's likely to happen. 4.49 candles going down is normal, so it's likely to happen. Okay, so that's what this is telling you. And this, by the way, you didn't ask me, but let me answer it, because you may have this question. You guys may have this question afterward. This has a lot to do with these conditions that are tagged as hopeful or sensible. So what is a sensible trade? A sensible trade is when the amount of candles that are taking place in the current condition, okay, are much less than the statistical amount of candles that this market tends to be in that condition. For example, in this case, in an up market, that market, Boeing, BA, tends to stay up in the daily time frame by 9 candles. Well, currently, the current climate for BA is that BA has been going up for 2 candles. Okay, so I mean, I can switch it here, so you can see that. So BA is loading here on the bottom. Okay, so BA. Okay, so you can see we got 2 candles into the sapphire color climate. Okay, so that's what this number 2 means. Okay, and then what we also know is that when Boeing is going up, typically it tends to stay up by 8.91 candles. Now, we also discussed in our sessions that sometimes we may get different values. Here it says 10, well, here it says 9. Why is that? Well, because I got 500 candles loaded on the chart, where on my radar screen, I'm loading 200. So I got a different amount of candles. So if you were to make it 500, then you would have the same values. Okay, but again, we also said in the sessions that we don't need to, get paranoid about those values. This is about avoiding getting in too late, right? And no matter if it's 10 or if it's 8, okay, I guess we all agree that if up markets for Boeing tend to last 8 or 10 candles, and you are about to enter in candle number 2, I think it's fine to say that this is a sensible long, meaning that you are not entering too short. Sorry, you are not entering too late, okay? Where if you were to, for example, if you were to get into this one, IBM, okay? So IBM, let's take a look at IBM. IBM has been falling for 15 candles now, okay? We got 15 candles going down climate for 15 candles. Where the fact is that when IBM falls, typically it tends to last 4 candles. Okay, so if you were to get short now, expecting it to fall even more, I mean, I'm not saying it's crazy because the climate is down, but it's hopeful. Hopeful in the sense that you are probably late to the party. Okay, the move down, this particular climate, started 15 candles ago in the common time frame, and you plan to enter using an edge time frame, well, that's probably too late. Okay, so this is what hopeful and sensible means. And again, this is designed to add a little bit more odds in your favor in the sense of avoiding you to get in a trade too late. A classical, and please confirm if you have heard anyone ever say what I'm about to say or not. A classical complaint that I heard among traders, not at the beginning of their trading career, but after a while, when they started practicing trading, common complaint that I heard many traders say is that, well, I've been learning how to go long and I've been learning how to go short, but no one ever told me when to not to trade. Okay? If I ever knew when not to trade, I would have avoided all those losses, right? So have you guys ever heard that complaint among traders? Right? So again, I'm just waiting for your answer with, there's always a little bit of delay with a YouTube broadcast. But it's critical, okay, that you guys have this information under control, because again, just as it's very important to go long or go short, and of course go long and short at the same time, at the right time, it's also important to know what to do, which, by the way, climate is step 1 in our flow chart, isn't it? So this is what this is designed to do, to tell you if it's still time for you to enter or it's not time to trade. Okay, trade another market. There are many. Okay, cool. Very good. So let me see. Let me see. Orlando, thank you, Jose. Very powerful. Thank you so much. Yeah, we need filter rules. Yes, we have the filter rules. We covered those rules. Orlando, let me show you where the rules are. So I'm just gonna get into our YouTube channel. So youtube.com/tradewithufos. By the way, everybody click subscribe, click on the bell, and if you're happy with the session as well, give us a thumbs up. And by the way, just quick, since we are here, quick reminder. I hope all of you are taking your vitamins every day, guys, okay? Make sure you are watching the sessions that Brian is putting together beautifully. Okay, make sure you are connected with Brian. Brian also is keen. He has shared his email with you guys. He's also keen to receive questions and so on. So make sure you are using all those resources, okay? So everybody take your trader's vitamin in a regular basis. Take your vitamin T, my friends, okay? So apart from vitamin T, we got to get together. If we look at sharpening, and I click on the full playlist, we had a session on the 11th, which is about auto climate. Okay, so in that session, Orlando, I did explain the rules. Okay, and what I'm going to do here is to summarize it very quickly. Okay, and the rules basically are, okay, when you would just pick, first of all, you define the climate, okay, which in this case is clear. It's a down climate. Number two, you would look at how likely that climate is to last. So you take that figure and you round it up. So even though it's 462, in your mind you're thinking 5, okay? And then you look at this figure. And if this figure is less than 5, you just go for the trade and you are very happy, okay? Because it's a sensible trade based on the terminology I just covered, okay? It's sensible. But what if it's above 5? Well, if it's above 5, you're gonna give yourself wiggle room, which is 50% extra than 5. So how much is 50% above 5 is 2.5, so it's 7.5. So if this number is between 5 and 7.5, you still take the trade, but you will reduce your size by half. Okay, you just cut the size of the trade by half. That's it. Okay, and if it's more than 7.5, okay, so if this number becomes 8, then you don't have permission to trade anymore based on the method, because now you are too hopeful. Okay, so a little hopeful is okay. Sensible is ideal. A little hopeful is okay, but cut the size in half. Too hopeful is not enough, because that's gambling now. So we don't take the trade. Those are the rules, okay? So again, let me give you one more example, just in case. For example, Boeing. So with Boeing, we said we had 2 candles into the climate. The climate is blue sapphire. So you take 10, you round it up, so that's 11. Because 2 is less than 11, it's sensible. You just go for it. Take the trade. Done. Okay, full size. Take the trade. Okay. Now, what if it was more than 11? Okay. What if it was more than 11? Well, remember, you take that 11, calculate 50% of 11. So 50% of 11 is 5.5. So 11 plus 5.5 is 16.5. Okay. So anywhere above 11 all the way to 16.5, you are still okay taking the trade. But you would cut the position size in half. If you normally risk 1% of your account, you risk 0.5% of your account. Why? Because the climate, begins to be in a stage where it's starting to become risky. Okay, so you cut the size in half. Okay, that's it. Very good. Let me keep going with your questions, guys. I'm just gonna go ahead and keep going. We'll have no break today, guys. Okay, I'll just keep going, answer all your questions, and when we are done with the questions, we'll be done for today. Okay. Let me see. So the next question I had, comment here from Ahmad. I use 20 for my stop, so my entry and my stop is between 9 and 20. Okay, I understand what you're doing. Again, makes sense, Ahmad. At the same time, remember, the consequences of doing that is that you are putting your stop far away, which will reduce the probability of being stopped out, but will also increase the size of the losses. Okay, so careful with that. Okay, and certainly I can see you have rules around it. So I like what you're doing in the sense that it's mechanical. Okay, make sure emotions will not impact you when it comes to today I feel like using the 9 only, today I feel like using 9 and 20 as well. And you keep changing rules depending on how you feel. I'm not saying that's your case, but I just wanted to say it in case anyone was thinking about it. Okay, that would not be the right way to think about it. You need to be mechanical. Ray Salani, how are you? question here. So in a long-term long call position, what is the best way to protect profits while staying in the position? SLV current delta is 0.76. The best way is to hedge it. Okay, hedge it with a dynamic hedge. If you are in a long call, you have positive gamma. So what you could do is go ahead and take a look at the session that we did in June 29 with gamma hedge. Okay, and what you could do is that you could short shares of SLV against your call, producing a still positive gamma position while you lock in profits. And now if it goes your way further, you make more. And if it goes against you, not only you locked your profits, but you would make more even if it moves against you. Okay, so take a look at that session because of course there is more to discuss, and we have a 2-hour session there where we discuss that concept. Also, one more thing to keep in mind, you could create that gamma hedge by using puts against your call as well. Okay, but now you need to use very deep in the money puts and stuff like that, and it's not as simple as just using shares. Okay, but all of this was explained in that video if I'm not mistaken. Okay, good. Nice questions, guys. Nice questions. Auto climate is perfect to scan the market. Thank you, Ahmad. Yeah, Orlando, I know you'll be playing back that session, I'm sure. But anyway, thanks for giving me the opportunity to review the rules as well, because it's always good to reinforce. We should look to join the party for Boeing. Okay, so let's take a look. We may have a trade. Yeah, we may have a trade. Do we have it? Do we have Boeing here? Interesting. Something should be happening with Boeing that doesn't meet my rules. What is it that is not happening that meets my rules? So probably it's a matter of liquidity. Yeah. It's either liquidity or the value of the options that are not low enough to do this trade. Okay. Probably this is what's happening to Boeing. Okay. But certainly from a purely directional point of view, we got 50% using pre and post market, regular session, we got 47. Okay, so in the case of Boeing, actually it's better to use pre and post market. So, let me see. Oh yeah, no good. Pre and post market, yeah, now I got it right. So 50, yes, is good. So we got 341 is the average. Unfortunately, 341 is a little bit in the middle of nowhere. Okay, but when the market opens on Monday, I would not be surprised to see Boeing, to see the average higher, and maybe that average now is lining up with a 346 or 340 something. Okay, so we need to wait for on Monday to plan on this trade. But certainly there may be an opportunity, and when looking at targets for Boeing in a weekly time frame. So we are looking at potential moves all the way to 383. Okay, so this is like $20+ move. That's a nice one. Okay, so that could be a nice trade. Okay, so certainly keep that in mind on Monday for you to review once the market opens and the moving average updates, and that may be an opportunity to get into that Boeing. That's, by the way, that's the beauty, with the scanner. To be honest, the scanner is amazing also because we have incorporated the filter with the pricing of the options and so on. But the red screen with your auto climate in it is also quite neat. And what you could do is to scan with the scanner and then copy and paste those symbols. Okay, you can select the symbols, right click and copy, and you can then paste those symbols into the red screen with auto climate in it, as I just showed you earlier. Okay, so that could be a very valid way on how to do this. Okay. Anyway, so it seems that I have covered all the questions. I would say so. Did I leave any question unanswered, everybody? If that's the case, that I did cover all the questions, then we would call it a day. Today it's a simple sharpening session, okay, but still important, and very appreciative that you guys using your weekend time to join me, okay, because of course this is teamwork, and the benefit is for it's more for you than for me, but at the same time I really appreciate you joining as well, because that way we speak the same language, and then when we are doing trading during the weekdays, the sessions can be conducted in a much more efficient way, and I don't need to re-explain certain things, so you make my life much easier that way, and hopefully I can help you better this way as well. So thank you for joining me today, guys. Super pleasure. Keep up the good work out there. I'm loving what I see when you guys are getting in touch with me via emails, or maybe not with me, but when you send emails to the team, they always, sometimes you guys are so sweet. You send some very nice words for me, even though the team is grabbing those emails, but they always let me know. So thank you so much, guys, for such nice words for me, and being so supportive as well. And definitely keep up the good work. I'm super proud of what you guys are doing, so keep it up, okay? And I will see you again during the week. I believe we have a vitamin T session. I believe it's gonna be, let me say it right. So we have a vitamin session. I believe that I'll be doing the get together on the Wednesday, if I'm not mistaken. So the get together session, it's taking a little bit of time to load for whatever reason. Okay, almost there. Here we go. So get together. Okay, come on, get together. Here we go. So yeah, Monday 7 p.m. we got the vitamin T, and then I'll join you guys on Wednesday 9 a.m. for short term. Okay, so it'll be Wednesday, not Tuesday. It'll be Wednesday. I will see you then. I'll be around as well on Monday with the vitamin T session, so I'll say hi at that time as well. Okay, guys? But again, super pleasure. Keep up the good work. See you soon, my friends. Enjoy the rest of the Sunday. Bye-bye, everyone.